All right, let's talk about something that I think a lot of us have felt. You get that massive tax bill. You look at the number and you just get this sinking feeling. You can't help but wonder, is my own tax professional really on my side? Well, today we're going to pull back the curtain on the tax advisory industry itself. We're going to look at a fundamental conflict of interest that could quite literally be costing you a fortune. So let's just ask the question straight up. Is your tax professional working for you, or are they in a way working for the tax office? It gets right to the heart of this really common frustration. You hire an expert, you pay them good money to minimize your tax burden, but at the end of the day, you're still stuck with this huge bill. It makes you wonder, whose team are they really on?
And listen, this isn't just some made-up scenario. This happens. According to expert analysis, situations just like this happen every single year. Real people who think they've done everything by the book end up overpaying by tens, sometimes even hundreds of thousands of dollars. I mean, just think about that. That's money that should have been in your pocket.
So what is actually going on here? How can you hire an expert to save you money but still end up with a shockingly high bill? Well, here's the thing. The problem usually isn't that your professional is bad at their job. It's more likely that you, and maybe even they, misunderstand what their primary job actually is. Okay, so how do you know if this is happening to you? Well, analysts point to a few red flags. See if any of these sound familiar. You're told, hey, we've maxed out all your deductions, but the bill is still huge. Or maybe you only ever hear from them once or twice a year, right in the middle of that tax season rush. If you bring up an idea, it's shot down immediately. These are all signs that you're in what's called a compliance-only relationship. All right, here is the absolute key to this entire puzzle. It lies in one crucial distinction. A distinction that, frankly, isn't widely understood, but it is the secret to unlocking massive savings. We need to break down the two very different games being played in the world of taxes. This slide really lays it all out. On one side, you've got tax accounting. Think of this as looking backward. It's all about historical data, making sure the numbers add up, and simply following the rules. But on the other side, you've got tax strategy. This is all about looking forward. It's about planning, about proactively leveraging the rules to get you the best possible financial outcome. Two totally different mindsets. Let's dig into tax accounting for a second. Think of this as playing defense. Its only job is to take all the stuff that already happened last year, put it in the right boxes on the right forms, and file it on time so you don't get penalties. It is absolutely essential, don't get me wrong, but it's fundamentally reactive. It's just history. Now, tax strategy. This is pure offense. This is where you go on the attack. The goal here isn't just to report what happened, it's to architect what will happen. It's about structuring your finances, your investments, your business all year long to legally and ethically minimize the amount of tax you'll have to pay in the first place. This is where the life-changing savings are. Okay, so the big question is, if strategy is so powerful, why isn't everyone doing it? Why does it seem like most tax professionals just stick to compliance? Now, the answer isn't that they're lazy or unskilled. No, the answer is that the system itself, the entire industry, is built to incentivize compliance. You have to look at it from their perspective for a minute. For the preparer, just sticking to compliance is, well, a much better business model. It's faster, it's easier, especially when they're drowning in work during tax season. It involves way less risk and liability, and it lets them process a high volume of clients efficiently. It's just safer and more scalable for them. And right there, that's the paradox. That's the conflict of interest. What is safer, easier, and more profitable for your tax professional is often a heck of a lot more expensive for you, the client. The path of least resistance for them can be the path of greatest expense for you. Okay, I know this might still sound a little bit abstract, so let's make it concrete. Let's look at a powerful, real-world example where this all comes to life. Real estate investing. This is a perfect place to see how a strategic approach can produce wildly different results.
So first, we got to talk about this amazing tool in the strategist's playbook called depreciation. The simple version is the government lets you deduct the value of your rental building over time. Now here's the incredible part. You get to claim a paper loss for tax purposes on an asset that is, in the real world, probably going up in value. You're literally getting a tax break on something that's making you richer. So your typical compliance-focused preparer, they're probably just going to take the standard, slow as molasses 27.5-year depreciation schedule. But a strategist, they're going to do something totally different. They're going to recommend what's called a cost segregation study. This breaks the property down into its components, like carpet, appliances, lighting, and allows you to depreciate those parts much, much faster. It pulls all those tax savings into the present. And the impact of this is just staggering. By using a strategy like this, investors can often claim 40, even 50% of the total deduction in just the first few years. So what does that really mean? It means a ton of cash back in your pocket right now, cash that you can use to buy another property or reinvest somewhere else. But wait, it gets even better. This is the real kicker. For people who qualify, these big paper losses from depreciation aren't just for wiping out your rental income. Nope, they can actually be used to directly lower the tax bill from your main source of income, your W-2 job or your primary business. It's a huge benefit. So look, the main takeaway here is not to say that compliance-focused professionals are bad. Not at all. It's that they serve a very specific and very different function. And if you want to win this game, you have to understand who's playing what position on your team. I love this analogy because it just makes it all click. You wouldn't go to your dentist for heart surgery, right? They're both critical medical professionals, but they have completely different specialties. Well, tax compliance and tax strategy are just as different. You need the right specialist for the right job. You know, the most sophisticated financial approach often means having both. You need that compliance specialist, your tax preparer, to make sure the filing is accurate every year. That's your defense. But you also need a strategy specialist, a tax planner working with you all year long to shrink the number that goes on that filing in the first place. That's your offense. And that really brings us to the final, most important question you need to ask yourself. Take a hard look at the people you're working with and ask, what is their primary function? Is your team just built for compliance? Or is it truly built for wealth creation? At the end of the day, your best defense against overpaying tax and your most powerful tool for building wealth is being an informed client. Once you understand this crucial difference, you can start asking better questions and build a team that actually serves your real financial goals. So we'll leave you with this one last thought to chew on. When it comes to your money, your future, and the tax office, is your financial team just playing defense, trying not to lose? Or are they actively on offense, strategically planning to help you win? The answer to that question could be worth a fortune.